Hi, I'm Patrick Tuttle, the real estate guy with Legacy Real Estate Services, and in today's episode of FAQ Friday for June the 24th, we're talking about mortgage loans. Alright, hey folks, so welcome back. Today, June 24th, 2017, Jonathan asks a question about mortgage loans. And Jonathan says, which type of loan is best when applying for a mortgage loan? And typically, Jonathan, we've got, it really depends on your situation. So we have something called a conventional loan, which typically needs a 5% cash down payment from you, if you can qualify for that. We have an FHA loan, which FHA loans typically have a 3.5% down payment for those that can qualify for those. And comparing the two, FHA versus a conventional, if you can afford the additional down payment of 1.5%, the conventional is the way you want to go because it'll save you some money on something called mortgage insurance premium. So if you got the choice between an FHA and a conventional, go the conventional route. Now, the other loan that we see a lot of here in El Paso is the VA loan, which is a loan guaranteed by the Veterans Administration of the United States of America. And that is for active duty service members, those that are in the 5 branches of the armed forces, that being the Marines, the Army, the Air Force, the Navy, and the United States Coast Guard. Those are the 5 branches of our armed forces. And for those folks that are either active duty or honorably discharged, they can qualify for a Veterans Administration loan with 0 down. So that's a great loan for them, and compared to a conventional loan, the VA loan will save money over a conventional 5% down payment. But if we have a 20% down payment, conventional versus VA, you probably want to go the conventional route because you won't pay the upfront funding fee for mortgage insurance premium that they collect on the VA loans. Now, another type of mortgage loan that we're seeing grow in popularity, especially with our older folks who have been in their homes for a long time and they don't want to move, there's something called a reverse mortgage. And a reverse mortgage is where essentially the owner of the property has the property and they borrow against the equity. They get a lump sum most of the time, and then each month they have a small portion of mortgage paid back to them, very much like an annuity. And then they receive what's called a life estate, which allows them to stay in the property long term so that they can get their equity out of the property, use it for living expenses or whatever it is that they might want to do, and then they can stay in the home forever until they die. And that's what a life estate does for them, is that once they have that life estate, they can stay there until they die. So, Jonathan, I hope that answered your question for today. If you are watching this and you've got a question you'd like answered, please drop me a line. Shoot me an email, patrick@patricktuttle.com, or post it here on Facebook or on YouTube, wherever it is that you're seeing this video, and I'll be happy to answer one of your questions in an upcoming episode of FAQ Friday. Thanks for watching. God bless you, and make it a great day. Bye-bye.